Hi, I'm Richard Murphy, and this is the 10th in the video series on the importance of tax transparency that I am hosting, and which is being made jointly by the University of Sheffield, where I work as Professor of Accounting Practice, the Global Initiative for Fiscal Transparency, and the International Budget Partnership. In this video, my colleagues from both the International Budget Partnership and the University of Sheffield talk about their experience on issues around deciding what to tax, which was the subject of the 9th video in this series. Fariya Mohiuddin works with the International Budget Partnership. I asked her about some of the problems many tax authorities have with one of the more basic taxes, income tax, and the issues it gives rise to.
In emerging and developing economies, the informal sector accounts for more than 70% of employment. This presents a massive challenge for governments who want to collect income tax. Generally, in most of these countries, the base of pay-as-you-earn taxpayers is quite narrow, as this requires formal employment, and within this narrow base, it is usually government employees that form the majority of these taxpayers, as well as large multinational corporations. These taxpayers also tend to be concentrated in capital and/or major commercial capitals. And this presents a further problem for federated countries, where states or provinces are meant to capture some subnational revenue through a portion of income taxes. Beyond the narrowness and geographic concentration of the tax base, there are two further aspects to consider: data and gender equity. Let's start with data. Given high levels of informality in the labor force and the concentration of formal employment in capitals and major cities, how do you figure out who is going untaxed across a jurisdiction? You cannot count what you cannot see through data. We will also address this issue later in the video series. The second is gender equity. The informal sector is highly feminized. In thinking about designing and implementing policies to tax the informal sector, governments must take this important feature into account. What are the differences between men and women in the informal sector? And how will this impact their decisions to enter the tax net and/or formalize?
My colleague, Andrew Baker from the University of Sheffield, has this to add about the risks that any tax authority has to consider when addressing this issue.
Risks can develop in a tax system that can undermine its capacity to collect revenue. And these can result from how certain taxes are designed, relate to, and interact with other areas of taxation. They can also arise if systems of administration are neglected, underfunded, and under-resourced. One risk is that if a large gap opens up between the top rate of income tax and a much lower rate of corporation tax, that creates an incentive for higher earners to move more of their income into the corporate structures they manage. This can undermine and effectively reduce a country's income tax base. We call this a tax spillover risk. Being able to document and assess such potential risks is an important element of tax transparency. The resulting information can play a key role in informing public debates on desirable tax policy design. It also means policymakers need to be mindful of how different taxes interact and relate to one another, while ensuring that large discrepancies that can undermine or harm other parts of the tax system or result in social imbalances and significant inequalities are avoided. Other risks arise from low rates of capital gains tax, which means people earning from financial investments can pay less in tax than people working or producing things. And that can potentially become a big distortion, as well as potentially undermining tax morale and general faith in the tax system. Likewise, very generous reliefs and exemptions on various investment schemes can reduce revenue raising while favouring high-income groups. It's important that such reliefs are evaluated and their impact, who they benefit, to what extent and at what cost, are tracked in the name of tax transparency. In addition, when revenue agencies have reduced budgets and staff, they can struggle to police the tax system effectively, and this also can pose a risk to the tax system. Risks can also arise elsewhere. For example, how companies are registered and monitored can create risk. Where this becomes lax and ineffective, it can pose risks to multiple tax bases, and it can obscure transparency and reduce the attainment of transparency in the tax system as a whole. It also reduces the revenue authority's capacity to play a full role in providing accurate, up-to-date information as an active player in a regime of tax transparency. There is, however, one essential lesson, which is that if an active regime of tax transparency is to be built, this requires revenue agencies to be resourced with staff, training, and adequate budgets, because this is likely to generate a range of societal benefits and pay for itself over time.
These and many other issues around these themes suggest one overarching conclusion. This is that life is not easy for tax authorities having to make decisions on all these issues, but that tax transparency makes their lives easier whilst greatly assisting the understanding of what they're doing in the wider community. Tax transparency really is the key in that case.